Welcome back. In this session, I will be explaining to you the general features listed in the IAS 1 about how to present a financial statement. There are several features. We will focus on some of them. The fair presentation and compliance with IFRS, going concern assumption, offsetting, materiality and aggregation, accrual basis of accounting, comparative information, consistence of a presentation. Fair presentation and compliance with IFRS. It means that it requires financial statement to be presented fairly, the financial position, financial performance, and cash flows of an entity. It also requires faithful representation of the effects of transaction, other events, and conditions in accordance with the definition and recognition criteria for assets, liabilities, income, and expenses set out in the framework. International Accounting Standard 1, IAS 1, requires that an entity whose financial statement complying with IFRS make an explicit and unreserved statement of such compliance in the notes. In some circumstances, but very rarely, an entity may disclose a departure from the requirement, and the entity should provide sufficient justification and explanation for why such departure existed. Materiality. An entity shall present separately each material class of similar items. An entity shall present separate items of dissimilar nature or function unless they are immaterial. As we have said earlier in the previous lesson, materiality depends on the size and nature of omission or misstatement judged in the surrounding circumstance. Offsetting, it means that an entity shall not offset assets and liabilities or income and expenses unless required or permitted by other IFRS. Going concern assumption, it means that the conceptual framework notes that financial statements are normally prepared assuming the entity is a going concern, will continue in operation for the foreseeable future. So IAS 1 requires management to make an assessment of an entity's ability to continue as going concern. If management has significant concerns about the entity's ability to continue, the uncertainties must be disclosed. If the management concludes that entity is not a going concern, the financial statement should not be prepared on a going concern basis. Consistency of presentation. It means that the presentation and the classification of items in the financial statement should be retained from one period to the next, unless the change is justified, either by change in circumstances or requirement of new IFRS. This would allow the users to be able to compare the past results, historical performance, and the present performance. Let's look at this exercise. As we all know, during the COVID period, a lot of companies experienced a significant decrease in their revenues. So for example, Company A has such a decrease in its sales. It also has significant bank loans that are coming due. So it's concerned whether it can survive and also pay back the loans. The owner of the company are concerned about economic situation, but do not intend to close the business. So does the going concern assumption apply to the Company A's financial statement? I would like you to pause and think what would be your answer to this question. The answer would be yes. Although Company A is not having a good business year, it does not have any intention to close the business. Therefore, the assumption that it will continue to operate is valid. The financial statement should be continued to be presented under that assumption. Depending on the seriousness of the business downturn, The company A may disclose this in its financial statement in the disclosure in the notes part. Have you get this right?